Hey, what's going on? Ben here, and today I just want to go over our Nvidia options trading strategy that is on our blog here. And so I just kind of wanted just to show just some of the simple rules and how it works and how you can get in on the next trade um, with this strategy. So it's very simple. The rules are pretty straightforward, and so let's go ahead and check this out. And so really all you need is Webull, Robinhood. You can even use TradingView. You can use anything, pretty much any trading platform out there. In our case, we're going to use Webull. And so the first thing you're going to do is pull up Nvidia on your chart. So we got Webull right here. So let's go ahead and pull this up. And we want to go all the way up here and navigate to Nvidia. And so we just type in NVDA. That is the ticker. And so we're going to go, the next thing, actually, I'm going to hit myself. So that's the first thing you do, right? So step one. Step two is you're going to go and put EMA moving averages on your chart. So you're going to go all the way up here on the indicators button. And so this will be different in a variety. I'm not going to go into all the different platforms because there's like a million platforms out there. But you'll go up here to indicators and then click on EMA. So that'll add your EMAs to your chart. And then you're going to click on this little guy right here. Well, actually, I can't do it, but there's a little guy right here. And you're going to see the inputs. And so you are going to want to change your inputs. Okay. And so you're going to want to do 5 and 15. And then you'll just deselect. So you'll just select both of these. So EMA 5, EMA 15. So you see these two right here. These are the two indicators that you'll need. And so what I did to make it simple is I made the EMA 5 red and then the EMA 15. Let's go back to that green. And so red and green. So that's what I recommend you do just because it makes it simple with the rules. And so perfect. So that is the rules here. So yeah, we go into the rules and so boom, right there. And so we have 3 simple rules. So there's 3 simple rules of the system. And so rule number 1 is the red 5 EMA must cross above the green, or it must be above it. So it's got to be above it on the chart. And so we're only looking at the daily. So one of the specific rules with this is that we're going to be looking at the daily time frame. And so there's daily, there's weekly, all the way down here. There's minute. You can see all these time frames down here. We are only looking at the daily time frame. So this one right here. And so that is what this strategy works best on. So that is the time frame that we will use. And so, yeah, so the first rule is it must cross above. So let's go ahead over to the chart here and let's actually zoom up to our example in this article. And so right here we had so say this is price action right here. This is obviously back, this is going back in time, but we're coming all the way up here and we see that this candle quite isn't above the moving average. So the moving average is still right here. It's not quite above it, so that is not where we want to do. We want to wait for the next one. So this actually is above it, so that it is above it, but it didn't close above it, and so that's where we want. That's what we want for an entry condition. So yeah, the rule number 1, red EMA must be across above. So I'm actually getting one step ahead of myself because what we really want to see is this right here. So the first step is this right here. Red EMA is above the green. So there's the red, here's the green. That is what we want to look for right there. And so that's our first. So right here is where we're like, okay, we're interested. Okay, so let's go ahead now and go to the second one. So the confirmation candle. So the confirmation candle is, it's a good sign that the red is above the green. So obviously that's pretty simple, straightforward. But now we need a final confirmation. And so what we want to do is we want to look for, so this isn't it. So this is still in, the moving average is still touching. And so, we need to wait for the entire candle to close above the moving average. So right here, and actually look at that on our chart here. This is our entry. So the very next day, once this close out here, the very next day is when we would have entered into this trade. Let's go ahead and hide that. So the next thing you got to do now is to pick your option. And so we are looking for options that are 90 to 120 days out at or near the money. So essentially, for an example, now this is obviously back in time, but say we are looking at a trade currently right now, we would pick something like right here on October 24th or October 18th, and then we go all the way down here at or near the money. And so you can see right here. So this will be it'll be actually Nvidia is down today, so these are down pretty good. But it'll be around. So that's $1,500. You could get a little more. You could go out of the money a little bit. Um, not too much, but you can go out of money a little bit here. Um, the farther you go, the more risky, obviously it is. But I like the strategy at or near the money. I think that is where it would best be. Um, so yeah, so if you know, and it'll basically just be a simple call or put option. To be single. It won't be any kind of iron condor, straddle, anything like that. We are just looking at a single option and just one. You could do more than one, but in this case, we'll just do one, and that is what your option would be. And so the stop loss and exit conditions are pretty straightforward. And so, yeah, the exit is simple. And so basically, you exit trade when the price closes below both moving averages or when it crosses over. So in this case, in our example here, we got in on that trade here. So we would have got in on that 90-day, 90 to 120 days out option. And so you can see how it just stayed above this moving average, and it was a really nice move. Dipped down a little bit here, but then just kept going. Dipped a little bit here, kept going, and then this candle right here, it didn't actually close below it. Not until this one, and actually that line. Let me actually go ahead and go over to the chart just to kind of show you guys it in real, or just on the chart. So let's go up here, and so right here you can see it closed below it. So that is where we went ahead and exited it. Now it did touch it a little bit here, but obviously if you're up as much as you would have been here, you would have been very much happy to get out because our entry was all the way down here, and it was a really nice move. And you can even use some tools on here. Let me go to the drawing tools, and so yeah, we would have entered right here. So that is a 29% move, 43 days, and up 15 bucks there. So really good trade. So I think you would have been happy to exit that because this would have started to come down and just that would have been great. So that's where you exit. So exit right there. Now you did notice that it did cross below here, but then just kept going back up. And so there is a good. In this case, we would have actually gotten in a second trade, and I'll actually show you that here in a second. And so yeah, so that would have been a 29% move. Great trade. So there's exceptions here. So not exceptions, but there is for the stop loss. So when do you get out? How do you get out, or where do you place your initial stop loss? And options are a little bit different, but you can have you could have a stop loss. But what we'll do for this case is that if price closes below the both moving averages, you get out no matter what. So if the moving average crosses back over, this could be a sign that there is some choppy days ahead. So you're going to go ahead and get out. And so here's an example of that. And so say you would have X entered on this entry candle. So this is our daily entry candle, and you would have gotten in, somewhere here, probably even down here on the at 9:30. Um, this would have been the sign where you're going to go ahead and exit because it did come back down, and so that did go sideways, and it actually ended up going back down, and actually this ended up going way down. So that is where you would have exited. And I actually did skip that step, but you do. So let's go ahead and go back up here. On this entry candle, we are going to go ahead and get in at 9:30 as soon as the market opens. So you see this how it. So basically, you're getting in on the next day, unless a pre-market there's some crazy action happening. You would have gotten in right around right here. right at the start of the day. So that is when you enter right at 9:30. You can wait a couple minutes after, but just to make it as simple as possible, that's the entry time that you would get in. Okay, so basically here's that example entry entry right here on that 9:30 a.m. and then we would have been exited out right there. So great trade. Let's go ahead and keep going here. So yeah, so we got the stop loss. We know when to get out. And so let's go see if there's other examples. And so other examples of this strategy. And so here is the very next. So that trade, we would close out on 221. The very next day would have been another entry. So here is and let's go ahead and look at the chart. And so here is the next candle. And so this would have been the next trade. And so we obviously exited there, and this was actually earnings too, so that could have obviously have driven it up. And you could do more, there's definitely more stuff that you can do aside from just trading these with this indicator. Obviously, if there's earnings coming up, if there's news out, it's going to drive things up and down like crazy. But in this case, we would have waited for after that, and then yeah, we would have gotten in this example right there. And then boom, it was a nice trade. And then it would have exited. Let's go ahead here on a moving average cross. So there's two different exit criterias that you could do. You could exit on a cross like this. So that means that the probably going back and going back down. Or you could exit when the candle closes below those moving averages, like our first example. In this case, we had a moving average cross that happened first. Whatever happens first, that is where you exit. And so, like I said, let's show this again. Entry right here on this break above the moving averages, and we exited on the. So again, this is you really can't get more simple than this. But I like this strategy because it is just dominant. When you see these, so here's an entry here. Um, let's go ahead and go back, and there have been the exit, and so we're actually in, and so we actually have a really big down move today. But in this case, you see here a little sideways action, and so here was the entry candle. This would have been 4 days ago. So you had had a nice, you'd entered right here at the start of the day, and so yeah, it was a nice move. Don't know what's happening right now, but in this case, this was a really nice couple days so far. But again, and so in this case, if you would have taken this trade, you still be up a little bit. But if this comes back down here and these moving averages are like this, like this, and the candle ends up closing below, okay, we're gonna go ahead and get out of this trade. And so if this might just be a minor pullback. The market, I'm not sure what the market's doing, but it could potentially go back up. But yeah, that is where you would be getting out. So you can get out of these trades within a day. We're not bumping down on any time frames in particular. 15, 30, hourly. You can. It's about the crossover on the hourly. Even the 4 hour, it's about to touch the bottom one. 15-minute probably already crossed. Yeah, it already crossed. So you can do that. You're very well, and you can actually add a lot of extra stuff. Now, I don't want to just make this strategy just impossible, because what happens with people with strategies is that they'll have a very simple entry and exit conditions for something like this, and then they'll just start adding 20 different elements, and then to the point where you're like, I don't even know when to trade. So that's what we don't want to do here. But anyway, so that's very basic. I just wanted just to cover that. And if you want to go ahead and read this article, go ahead to Trading Strategy Guides / Nvidia Option Strategy. And so we actually have this all laid out there for you. I just wanted to just do this video just to kind of show you exactly how it works and things like that. And so yeah, if you have any questions or comments, go ahead and hit us up at info@tradingstrategyguides.com, or you're more than welcome to comment below. Go ahead and make sure you like and subscribe. We would appreciate that here on YouTube. We would appreciate that if you would do that. And hopefully this is interesting enough. If it is, go and give it a like, leave us a comment, be like, hey, I would appreciate this again. We are looking to start doing this kind of content more. Um, we we did this a lot. We have many different strategies. Go ahead and check out our blog, and we have forex, stocks, cryptos, derivatives, tons and tons of strategy, tons and tons of content. Traders, we have thousands and thousands of people visit our website every day, and people love these strategies. And so, if you are interested in something else, if you have another stock you're interested in, forex, crypto, go ahead and check that out. Um, I do. Oh, I do want to point out one last thing before we go. You are more than welcome to buy. You can buy the stock actually instead of just doing options. With this strategy, you are more than welcome to just buy it. And so, right at the entry, go ahead and just buy shares, partial shares. You can start with $10. You can do $10, and this could even be a good time to just if you're a long-term holder and saying something like Nvidia, this will be a great time. You could just invest every time this does this. So invest right here, pull back, invest again. Nice little pullback, invest right here. So you're more than welcome to just continue to add to your position each time there is a signal for the buy side. You can also do this to the downside. You could do a put um, with the options, but I didn't show that in an example, but it would be the same exact thing. 90 to 100 and or what was it? 90 to 120 days out, and just do a put. So that's how that would work on the downside. All right, guys, that's it for me, and thank you very much.